With that, let's get to your market voice now. This is Saurabh Mukherjea of Marcellus. We hosted him a few days ago to ask what the strategy could be for the new year. There have been changes in the portfolio as well, with Tata Elxsi making way and Relaxo footwear going out. Here is Saurabh Mukherjea unplugged for the new year.
As a country, by and large, across sectors, financial services, IT exports, domestic manufacturing, we're in reasonably good shape. The challenge for us in India is that the rest of the world isn't in good shape, and specifically, the rest of the world still hasn't made up its mind as to when to start pulling back interest rates. Whilst both Europe and America have had a couple of CPI prints which are moving south, moving down, it's not yet decisive enough, I think, for their central banks to start signaling that the rate hike cycle is done. And I think until such time, global investors' mood will remain a little jittery. Remember, most global investors haven't seen they haven't seen rate hike cycles this powerful ever in their career. In fact, even in my career, I've never seen a 1 year period where the US rates go up 400 bips. So domestic economy in great shape, global risk appetite still soft. And until we get clarity on the global inflation picture, more decisive clarity, we're getting incremental clarity that the inflation picture is coming off. But until decisive clarity emerges on that, I think we will see a degree of trepidation across the world on equities, whether it's Indian equities, American equities, or indeed European equities.
So a lot of folks are saying a State Bank of India fixed deposit is giving 9% return. Interest rates sooner than later will peak out, which means bond would be attractive. So if you're buying into equities now, you're buying the market at a reasonable level. And if the possibility of a 10% return, which is a probability, versus a 9% assured return in State Bank of India fixed deposit or a double-digit return in debt, one should go for the latter, not for equities.
Yeah, so I think if you lived in a developed country and you got 9% on an FD, I would say take it every time. If I lived in a developed country and I got 9% on an FD, I would take it. But living in India and taking 9% on FD, even 9% on FD, I'm not so sure is a great long-term idea. Primarily because inflation for people like us, those people who are watching, inflation for us typically is around 6-7%. Our cost of living tends to go up a little higher than most other people because there's a huge imported component in our cost of living. And 6-7% inflation means that if your FD is giving you after tax, say 7%, you're not really creating wealth. Now, some people might be happy not to create wealth, but most people in my generation, most of my client base, want to create a degree of wealth for themselves. And I'm afraid that's not going to come from investing in fixed deposits in a country like India. That's only going to come from investing in high quality equities. And hence the premise that I put forward in my books over the last 4 or 5 years, that buy high quality companies, sit on them for long periods of time, and see your wealth expand at anywhere between 15 to 20%, depending on your portfolio and your patience. But the era of investing in FDs and creating wealth, I think that sort of ended roughly 20 years ago.
Let's look at your portfolio companies which have come out with numbers so far. Asian Paints yesterday, ICICI Lombard I think earlier this week, HDFC Bank over the weekend, and TCS was the first one to come out with numbers. Mm-hmm. What's been the standout miss for you? What's been the standout hit for you?
I think the sort of the most positive development I can see is right through last year, people kept telling us, they kept telling each other that there's a global slowdown, IT services will be hit, and people like us kept saying, and I think I said it several times on your show, Nikunj, that I don't understand how you can be bearish on IT services. It's like being bearish on steam engines at the heart of the industrial revolution. So I think this time around, I think fairly convincingly, not just TCS, but also Infosys, even HCL Tech, the results quite convincingly show that regardless of what happens to GDP growth in the Western world, the migration to cloud, outsourcing to India, these are incredibly powerful themes that will power through an economic slowdown. And that sort of reinforces our faith, which is why at one level, actually, in our mid-cap portfolio in Rising Giants, we've gone ahead and added Tata Elxsi. So over and above L&T Technology Services, which was already our existing engineering R&D play, we've added another engineering R&D play, Tata Elxsi, similar sort of drivers. The West needs more Indian help for engineering, for research and development. They don't have that many STEM graduates. We have more STEM graduates. We have high quality companies with great pedigree. So I think this area is something we'll keep looking to build on. A decadal 10-year surge in Western intellect related work migrating to India. The area where we're a little circumspect, and you could see that, say, both the Asian Paints results and also even Havells results. We don't hold Havells, but I think Air Electrical, it's a good benchmark to observe. There's a degree of top line softness in Asian Paints' case after, I think, 3 years of blistering top line growth, where I think they CAGR'd at 17%. You had a soft quarter on the top line, but thankfully it's made up by the fact that you've seen EBITDA margins recovering as the global commodity wave ebbs. Asian Paints, I think, saw a 400 bips jump in EBITDA margins. So we'll look forward to see, when the top line growth picks up a little bit. I suspect that might take a couple of quarters, but it's good to see EBITDA margins recover. And I think we'll see this across the market. The commodity price inflation surge is broadly done. And I think operating margins will recover both the quarter that ended in December, and I think also the same story in the March quarter.